JP Morgan is jumping on the lending bandwagon. We're looking at our 5th round draft picks, and Jimmy Kane is perfecting his bridge game. You're in the right place, folks, because this is where the money is. Welcome to the show. I'm Matt Copenheffer. As always, next to me here is David Hansen. We've got a great show today. But first, David, Apple was the big news yesterday. There are iPhones in gold now. Gold, David. Are you rushing to buy iPhones?
No, I do not want a gold phone. What's the point of a gold phone?
Well,
do you want a gold phone?
I don't yet. But if you're stockpiling gold bars in your basement for the coming economic calamity, don't you want a gold iPhone too?
That's a good point. What does Warren Buffett say? He says gold doesn't have a function. There you go. You're getting some
gold. Yeah.
It now has a function.
Proved Warren Buffett wrong.
You can call your mother-in-law.
Starting off as we always do with the headlines, we've got a interesting one to start off with at the Wall Street Journal. Vocal rule to curb bank trading proves hard to write. I will say that there's an alternate version of the headline also on the Wall Street Journal. Simple bank rule proves hard to write. David, why is this so difficult?
I don't know why it's so difficult. If you read the article is very, very long, and it details the SEC, the OCC, all these agencies trying to figure out, okay, how do we write this rule? How do we implement it? So it's really them trying to figure out, okay, how do we just finalize this thing? From the bank's perspective, a lot of them have already made actions as if it's going to be implemented. Goldman Sachs has scaled back a lot of their trading operations. JP Morgan has done the same. Bank of America has done the same. So from the bank's perspective, it's really kind of just waiting, okay, what's the final stamp of approval, and make sure we have our ducks in a row.
This rule is a disaster. This started out as a proposal that was less than 2 pages. They're now talking about this could be 900 pages or so. This is awful. This is at the same time though, so there's a balance between the two, right? So on the one hand, this process has just gone completely off the rails. On the other hand, I don't think that there ever should have been an expectation that you can take $1 trillion companies with $1 trillion balance sheets and be able to write some 5-page thing that Joe Schmo, who works in the accounting department of Procter & Gamble, would be able to understand easily, right? So there's going to be a little bit of complexity here, and I don't think you want to exclude market making from the bank's business. That's not necessarily a dangerous business, whereas they're defining proprietary trading as dangerous. But man, this has been a complete mess.
Yeah, it really has. But from an investor's perspective, I own shares of Goldman Sachs, JP Morgan. This doesn't make me nervous. They're already well positioned to handle whatever comes out of this.
All right, headline 2.
Headline 2, going over to Bloomberg. It says JP Morgan removes lending barriers in booming U.S. markets.
Booming.
Yes.
Boom.
So apparently JP Morgan, their mortgage lenders, they're scaling back their standards a little bit in the areas that are really seeing a lot of price appreciation. And this makes sense. We've seen competition ramp back up with mortgage lending for mostly all of 2012. It was Wells Fargo and JP Morgan, and everyone else was trying to get their ducks in a row to go out there and have loan officers to make these mortgage loans. Now it's ramped up just at a time where the volume's falling back a little bit, but that's kind of just the nature of it. They're going to have to ease the standards a little bit to get the business.
You didn't mention the names of which markets they were exactly, because probably you didn't want to scare people, because the markets, so some of those booming markets are Nevada, are Arizona, Florida. All of the worst performing markets coming in the crisis are coming out of the crisis, but they're doing very well now. I was just in Las Vegas a couple weeks ago, and there is a lot of activity there, and frankly, it makes sense to some extent. There's a lot of speculation beforehand, but now the activity makes sense to some extent, because there wasn't anything going on for a while. So you've got a lot that's been backlogged, and all of the building basically stopped. So you have very, very tight inventory there. The thing I think that people want to remember, though, is that standards got probably way too tight.
Right.
And so the initial reaction was, isn't this what got us into so much trouble, is having these super loose lending standards? So you want to find that Goldilocks point that's right in the middle, and maybe this gets closer to it. Obviously, we don't want to see banks loosen up too much, but we don't want them to be too tight where nobody's getting a loan, because that's bad for the economy, that's bad for home buyers, it's bad for home builders, and it's bad for banks.
Yep, absolutely.
Third and final headline, we're at Bloomberg again. Headline is U.S. regional banks root for Fed to ease squeeze on rates. Ease that squeeze. So the article essentially argues that the smaller banks, that there have been, we were talking yesterday about the Barclays Global Financials Conference, and there were a couple companies there in particular, Fifth Third and BB&T, that were talking about the fact that they're going to benefit from rising rates. So what's going on? Why would they want higher rates?
It makes sense, and the article points out, okay, if you're just a basic bank taking in deposits and making loans that are longer duration, so the higher end of the yield curve, you're going to want it to be steeper. You make more money that way. And the article also points out that the regional banks may be able to take more advantage of this than the big banks like Bank of America, JP Morgan are the ones they mentioned. I don't necessarily agree with that. They're in the same business. Yes, Bank of America and JP Morgan are in a lot of other businesses, big investment banks, big trading operations, but if it's a steeper yield curve and a more favorable lending environment, all banks win. It's not just these regional banks that win here.
Yeah, there's a scale difference, right? And so you have a lot more securities on the balance sheets of the big banks that will take a hit when interest rates rise. We saw that in the second quarter. That was pretty ugly. But if you look at the expectations of the big banks as well, they're all expecting to make a lot more money when rates rise, and that spread income is much more sustainable than owning securities that are yielding low rates, or this big refinance boom. And that's going to be one of the major casualties of rising rates is the refinance boom. We're already seeing that. We've got Bank of America cutting jobs, JP Morgan, I believe, is cutting jobs too, right? And Wells Fargo is cutting jobs, all because of the end of the refinance boom. Not really sustainable, but collecting that spread from loans that they make, that's sustainable. So we'd like to see a higher spread more than anything else.
Yep.
We had done our fantasy stock draft is it almost
Maybe
a month
month
ago now?
Yep.
Yeah, it doesn't seem that long ago. And we've gone through and we've reviewed the first 4 rounds of our picks. And today we're going to look at our picks from the final 5th round. You had
Annaly Capital.
Annaly Capital. What do you have to say for yourself on that one?
So there were 5 rounds in our draft, and one of the requirements was you had to have a REIT, whether it be a mortgage REIT, equity REIT, just like fantasy football. That's how we lined it up. So my 5th pick was Annaly Capital, a mortgage REIT, meaning they invest in mortgage-backed securities. They don't own properties and rent them out. It's not that type of REIT. So they own these mortgage-backed securities, and it hasn't been a great time recently to own mortgage-backed securities. Interest rates have been rising. Anyone out there that has tried to go get a mortgage, they've seen mortgage rates go up. We've seen 10-year treasury rates, those rise. So when rates rise, that hurts these securities, these fixed income securities. Rates rise, prices go down. And that has really been holding the stock back, holding the company back from really moving forward. And if we look at just a couple stats from Annaly here, going back to its inception, basically. And if we can throw up those stats here on the screen, we will take a look at kind of what the company has done since it became public. So if we just look at the stock price appreciation since inception, only up 3.5%. The stock price, okay? Versus the S&P of 53%. The total return, 522%. So the difference there is the dividend. Obviously, these are REITs. They have to pass through their income.
Sure.
And over time...
90%, right?
90%. So over time, reinvest those, take those as income. That's the result you get. So you can't really expect too much over the long term from a price appreciation perspective here. But getting that dividend over time...
522%, you're saying, is a pretty good return.
It's decent.
That's a positive.
We were, obviously, we were in a favorable bond period the last 15, 20 years. I
think it's been 30 or so.
Okay, so we'll extend that. But even the 15, 20 years that they've been around, it's been a good time for bonds. I will caveat to that. But the valuation does look cheap now. So if we throw the numbers back up and look at the bottom there, the price to book value right now, about at a 12% discount to book. Historically, it's been at a 15% premium to book. And if we look back at the entire span of Annaly, it's traded below book value only around 17%. of the day.
So what do you think the share is when we talk about a 12% discount to book? Some of that is probably expectation of book falling, and maybe some of that is undervaluation. How do you split that up in rough terms? What do you think the split is there?
In terms of going for what the expectation and what?
Yeah. So look out 2, 3, 4 years. How much of returning to that, let's say that it does return to that median book value multiple, how much of that comes from the book value falling and so the multiple rising versus the multiple rising from people from investors pushing it back up?
I think it's a pretty even split. It's right now, when we just think about the multiple, these things aren't fun to hold right now, and there's a lot of fear and pessimism that is into the multiples here. Yes, the book value is falling. We saw that in the second quarter. But again, I don't think you should be trying to time necessarily the book value of this. You're really investing in the management team here and their ability to weather through all these different types of environments and continue to collect that dividend and reinvest and take that as income. So again, if we look back throughout the time it's been public, it's been through a lot of scenarios. The median there was 1.1. It's really ranged a lot.
Sure.
It's a volatile type of multiple. It's a volatile stock at times, but over time, I think it could be a winner.
And you own Annaly in your personal portfolio.
I do, and I'm not expecting huge gains in the next 6 months. That's not the type of investment here. This is a long-term.
But over 5 years, huge gains, 522% or so.
I don't know about that, but we'll see.
So my 5th round pick was Aflac, the duck, and this was this is a tricky pick for me for this format because it's we're gonna be continuing to revisit this, and so we'll be looking at it over kind of short time frames, which isn't ideal. I don't invest like that. You don't invest like that. The story with Aflac is really this is a big picture, long-term type of thing. The business is supplemental insurance, and so when we think about what you hear in the Aflac commercials all the time, when you get hurt and miss work, that sums up the business pretty well. It's the idea that your medical bills and certain things will be covered by your primary health insurance and that sort of thing, but everything else, your extra expenses and all that. That's what Aflac helps you cover. So it's benefits over and beyond and outside of regular health insurance. So on Aflac's investor relations website, they outline their strategy, and the strategy is pretty simple. And I like when a company has a strategy that not only they share with investors, but that it's clear and that it's easy to execute on. So they want to continue to expand their product line, so continue to figure out supplemental insurance products that are in demand by the market, and then to focus on growing its distribution system of independent insurance agents and insurance brokers. And they note that nationally, there are more than 60,000 licensed Aflac insurance agents who coordinate and sell in the market. So again, these are agents out there at work sites or go into companies to talk to people about Aflac insurance. And I should note that predominantly Aflac's business is in Japan, where the healthcare system there lends itself well to having supplemental insurance like this. Let me give a couple of stats, and again, this talks to the long-term nature. I mean, this is a very well-run company that I think over a 5-year period, over a 10-year period, will deliver really good returns over the next year that we may be tracking this. Hopefully, we'll be tracking this longer than that, but 30 consecutive years, so 30 consecutive years of raising dividends. There's a particular subset of the S&P 500. They're known as the dividend aristocrats. These are companies that have raised their dividends consistently every year. I believe the cutoff is 25 years, but Aflac at 30 years of consistently raising its dividend. And you gave stats for Annaly since its inception, so let's follow up with some of those from Aflac. 100 shares of Aflac in 1955, when it was founded, cost $1,110. $1,110. That was in 1955. Today, without reinvesting dividends, and dividends, as 30 years of raising dividends, that's a big part of the picture, but without reinvesting dividends, those shares in 2012 would be worth $10 million.
Not bad.
That's not bad at all. There are some challenges that the company has had, particularly, and it's just like any other insurance company. You have the dual sort of revenue streams of premiums coming in. So you've got the premiums, and then you've got the underwriting profit, which drops down, and then the investing results. And the investing results haven't been great over the last few years. Maybe we can give them a little bit of a pass from the perspective that we had the financial crisis, and then the low interest rate environment makes that more challenging. Mm-hmm. I think that they've got that back on track now. That's something that investors, and then I'll be keeping an eye on. I actually own Aflac myself. But again, not really something that I expect big things from short term, but it's that compounding nature of the business. Just keeps growing, just keeps performing year after year, raising its dividend, returning capital to shareholders. This is a company that I'm very, very positive on.
The one question I'll ask, you mentioned the big business in Japan. When we think about international markets, Japan, is something like currency something investors should be worried about, or do you see it as over time that stuff will kind of net out? Is that something that crosses your mind?
Short term, the currency can, and recently it's been a big issue, and the movements of the yen have been a problem for the company, and I think they're trying to take some steps to manage that, because there are some very real consequences to the currency translations, and particularly in terms of how Aflac repatriates money made in Japan to the U.S. to be able to fund dividends and share buybacks, returning capital to shareholders. So that is a concern. That is a somewhat real concern. But really, what I'm looking at here is the core quality of the company and the business, and they can manage. A good company can manage something like that, but they can't control it. The currency movements are out of their control, so it's really just being able to deal with it well. So I think that they've done that relatively well, but I don't lose sleep over it.
Okay.
Moving on to the game for the day, and it is Fool in the Blank.
One of our favorites.
One of our favorites. So let me just jump right into the first one. Of the 4 big U.S. banks, blank will underperform the other 3 for the next 5 years. David, Fool in the Blank.
Worth noting, I think I agree with you. I know this is a feeling that you hold. All 4 of them, I believe, will outperform the S&P over the next 5 years. But among the 4, I think Citigroup will underperform the pack. Interesting, because if we look at Citigroup, it's the cheapest on a price-to-book basis or price-to-tangible book basis. So some might think, well, it's the cheapest. It has the most potential to make a run there. But their diversification is maybe a minus to me. The fact that they're in so many markets, I just see it as the probability, if we just think in probabilities, of something coming up and hurting their business that the other 3 don't have to deal with, whether it be in Asia, whether it be in Mexico, where they've been in the home lending business a little bit in Mexico there. So when I look at it from that perspective, just thinking probabilistically, I'm taking Citigroup. What about you?
This is a tough one for me. I'm inclined on the one hand to maybe put Wells Fargo in that spot because it's got the highest valuation. But it also produces such great returns, and over a period of 5 years, you have some opportunity for those returns to compound and actually add to the value of the company. I hear where you're coming from on Citigroup. Just to be a little bit different, I'm going to go with a surprise answer, and I'm going to say Bank of America. And here's the thing. I think it's important to note that I think as a group, they'll outperform the S&P 500 over the next 5 years. So when I say Bank of America could underperform those other 3, that is from the perspective of Bank of America still probably outperforming the S&P 500, just lagging those other 3 there. There's just so much that's gone on there that there are still issues to be worked out, including what's the next step forward? Where does the growth happen? How does the business start to get those big returns on equity again? Taking out costs will be a big part of the picture, and maybe that really does it. But there are question marks there. And Citigroup, while I agree with your analysis, there's also the possibility that they do really well and outpace a couple of the other banks. Number 2, Visa and MasterCard are poised to blank. David, Fool in the Blank.
Visa and MasterCard are poised to keep growing, if that makes sense. Is that right grammatically? They're going to keep growing. That's what I'm saying here.
Way to go out on a limb.
They're already huge companies, so I am going out on a limb. They're going to keep growing, get even bigger. When I look at the space, I try to find something that can knock them off. It seems like such an obvious space that someone else will come in and be a big player, since it's really just the two of them at the top. But I can't see it. I think they're going to continue to grow payment volume, continue to expand internationally, especially MasterCard. So they're going to keep growing. What do you say?
I say Visa and MasterCard are poised to deliver attractive returns.
Not outstanding, just attractive.
Not outstanding. Not outstanding. There's the possibility that they could deliver outstanding returns, but I think it's more likely, given the valuation, given all the excitement around them, and I know that it's been said all along that, oh, they're too expensive, but I don't think they're too expensive to produce attractive returns. I think they may be too expensive to produce huge outstanding returns. Number 3, blank would get me interested in buying AGNC.
So AGNC, American Capital Agency, the mortgage REIT, we just talked about Annaly. More fear would get me interested in buying American Capital Agency. So fear is what got me interested in buying Annaly Capital. I need more fear to be interested in American Capital Agency. Similar business models, not around as long. The discount to book is pretty similar to what Annaly is. I don't have the history of them performing well to turn to and say, okay, I have a lot of faith in this management team. Don't have that yet. So I would need to see more fear, a lower stock price to get me interested in AGNC.
It's an easy answer for me. Nothing would get me interested in buying AGNC. Nothing is the answer. I haven't seen anything that really gets me excited about the company, about being invested with that team, as opposed to other mortgage REITs out there. I don't own any mortgage REITs, but if I did, it would be not AGNC.
Fair enough.
Number 3, the $49 billion Verizon deal is blank for banks.
Fee-tastic. That is the word I'm going for. It's great. They're loving it. Who are the lead underwriters in this? Bank of America, JP Morgan,
Morgan Stanley.
Morgan Stanley. So some big players there, not surprising. It's great for them. Huge deal, great for their credit markets business. That's all you can say, Fee-tastic.
I'm not going to top Fee-tastic, so let's just move on. We finish off every day in the Twitter sphere. So David, why don't you give us the first tweet?
First tweet we're looking at is from Housing Wire, who is at Housing Wire, I believe. Yes, REITs start to look cheap, attractive, and they link out to that as a Barron's article out there. And we talked about Annaly earlier in the show, and the article really talks about a fund managers out there saying, I didn't think REITs were cheap a couple months ago. Now they look cheap, and Annaly is one that I think is could be a good winner in the space because of their management team, because of the price today. He said, I don't expect big returns in the short run, something that we said earlier in the show. I tend to agree with him. So yeah, I guess they're starting to look attractive to some people. I know you probably don't quite agree. But
I actually don't disagree. I think some of them do look cheap right now. And I would just be selective in terms of what management, because this is all about management, it's all about the jockey, what management teams I'm investing with. Annaly is one that I would consider. The other, which is a pick of mine in the fantasy stock draft, 2 Harbors, that would be another option.
Of course.
Number 2, tweet. We've got falling mortgage apps Vantage Point. This is at _Vantage Point _ MBA mortgage apps fell 13.5% as interest rates increased. 30-year fixed rate mortgages rose 4.8% from last week's 4.73%. And we've got a bunch of hashtags. Okay.
Yeah, that was
so
my thought as well.
Yeah, mortgage applications are falling, and we're seeing the fallout from it. Wells Fargo cutting jobs, JP Morgan cutting jobs, Bank of America cutting jobs. They're all trying to resize their business because this isn't a business that goes away. It just is cyclical, and so they want to right-size the business so that they can be profitable at lower levels of production.
Right, and people that follow the housing market closely know this, but if you're kind of just seeing this number, you might think, oh gosh, the housing market's in a downturn again.
It's crashing.
But when we talk about mortgage apps, that includes refinancing and also people actually going out and buying homes. So it's the refinancing that's really dragging this number down. It's not so much people going out and purchasing a home. That's actually weathering the increase in rates fairly well for now. There might have been some backlog there. We'll see if that continues for the rest of the year, but it's really the refinancing volume that's being hurt right here.
All right.
So the last one we'll go to, we're talking a little Jimmy Kane. This is from Annie Lowry. Dick Fold's a flailing consultant. Jimmy Kane's a top-ranked bridge player. The afterlife of Wall Street execs, links out to a Huffington Post there. Matt, he is playing bridge. He made hundreds of millions of dollars. If you made hundreds of millions of dollars and left the business, what card game, what board game are you turning pro in?
Card or board game? Well, it's close, but not quite there. I would go to horse racing. You know why? Because
Professional horse racing.
The
gambler, or are you being the jockey?
No. I'm actually too big to be a jockey, I think. The bow ties, the hats. I think I could. I really like the look of the avid horse race professional bettor. I've also done a decent amount of. I've done enough horse race betting to know that I need to know a heck of a lot more to do anything as a horse race bettor. The difference, though, is that Jimmy Kane has been a great bridge player for a long time. I'm a terrible horse race bettor right now, so I don't know it would translate as well. What say you?
I am a long-time Scattergories great. So I'm going with Scattergories. Great game. You got that dice with like 20 sides on it. Never know where it's going to land. You can use your imagination there. So Scattergories. If there's a professional league,
the big bridge tournaments are in Bermuda. I doubt that there are Bermuda-based Scattergory tournaments.
Looks like I got something to plan.
You'll start them up.
Perfect.
All right, folks. Again, I'm Matt Copenheffer, sitting right next to David Scattergories Hansen. We're glad you joined us. We'll be back tomorrow.